2008 financial crisis and his impact in the world. The build-up to the crisis, understanding the roots of the 2008 financial crisis. The 2008 financial crisis was a defining moment in global economic history, with widespread and long-lasting effects on the global economy. To truly understand the crisis and its impact, it's essential to explore the roots of the crisis and the factors that led to its eventual outbreak. The origins of the 2008 financial crisis can be traced back to the early 2000s when the U.S. housing market began to experience a significant boom. Low interest rates and lax lending standards led to an explosion in subprime lending, with lenders offering mortgages to borrowers with low credit scores or unstable financial situations. Many of these loans were adjustable-rate mortgages, with interest rates that increased over time, making them increasingly unaffordable for borrowers. The proliferation of subprime mortgages led to a housing bubble, with home prices rising rapidly and buyers taking on more and more debt. As the bubble grew, it became increasingly clear that many of these loans were at risk of default, particularly as interest rates rose and many borrowers were unable to make their mortgage payments. The widespread availability of complex financial instruments, such as derivatives, further amplified the impact of the crisis. These financial instruments, which were designed to spread risk across the financial system, ended up creating a web of interconnected financial obligations that was difficult to untangle. The collapse of Lehman Brothers in 2008 was a critical turning point in the crisis, triggering a broader financial panic that spread rapidly throughout the global financial system. The sudden collapse of a major financial institution sent shockwaves through the economy, leading to a broader loss of confidence and panic selling in financial markets. In the aftermath of the crisis, governments and central banks around the world launched a range of policy responses aimed at stabilizing the financial system and preventing a broader economic collapse. These policies included the Troubled Asset Relief Program, TARP, in the U.S., which provided financial support to struggling banks and other financial institutions, as well as a range of monetary and fiscal policy interventions. Today, more than a decade after the crisis, its impact is still being felt in many parts of the world. The 2008 financial crisis was a stark reminder of the fragility of the global financial system and the importance of responsible lending practices, effective regulation, and a stable financial infrastructure.
Housing market collapse, the triggering factor of the 2008 financial crisis. The 2008 financial crisis was triggered by the collapse of the U.S. housing market, which had been experiencing a significant boom in the years leading up to the crisis. A combination of lax lending standards, subprime mortgages, and complex financial instruments created a housing bubble that eventually burst, leading to a wave of foreclosures and defaults. The housing market collapse was driven by a number of factors, including low interest rates, which made borrowing cheap and encouraged homebuyers to take on more debt. Lax lending standards allowed borrowers with poor credit histories or unstable financial situations to obtain mortgages, many of which were adjustable-rate mortgages with interest rates that increased over time. As more and more people bought homes they could not afford, home prices began to rise rapidly. The proliferation of subprime lending created a feedback loop, with rising home prices encouraging even more lending and further inflating the housing bubble. The collapse of the housing market was further amplified by the proliferation of complex financial instruments, such as mortgage-backed securities and collateralized debt obligations. These instruments, which were designed to spread risk across the financial system, ended up creating a web of interconnected financial obligations that was difficult to untangle. As the housing market began to collapse, it became increasingly clear that many of the loans made to subprime borrowers were at risk of default. As borrowers began to default on their mortgages, financial institutions that held these mortgages or financial instruments linked to them began to experience significant losses. The collapse of the housing market eventually triggered a broader financial panic, with investors and institutions around the world suddenly losing confidence in the financial system. This loss of confidence led to a sharp decline in financial markets, with many stocks and financial instruments losing significant value in a matter of days. The housing market collapse was a critical triggering factor of the 2008 financial crisis, but it was only one piece of a much larger puzzle. The crisis was the result of a complex and interconnected set of factors, including lax lending standards, the proliferation of complex financial instruments, and a broader loss of confidence in the financial system. In the wake of the crisis, policymakers have implemented a range of reforms aimed at strengthening the financial system and preventing a similar crisis from occurring in the future.
The banking industry, how banks contributed to the 2008 financial crisis. The 2008 financial crisis was not only triggered by the collapse of the housing market, but was also largely the result of the actions of the banking industry. Banks played a significant role in contributing to the crisis by engaging in risky lending practices, leveraging their assets to an unsustainable degree, and investing in complex financial instruments. One of the key ways in which banks contributed to the crisis was through the proliferation of subprime mortgages. Banks aggressively marketed these mortgages to borrowers who had a poor credit history or were otherwise considered high-risk borrowers. These loans often had adjustable interest rates that rose over time, which made them increasingly unaffordable for borrowers. When many of these loans began to default, it created a ripple effect that spread throughout the financial system. Another way in which banks contributed to the crisis was through excessive leverage. Banks were allowed to borrow large amounts of money relative to their assets, which allowed them to invest in increasingly complex and risky financial instruments. When these instruments turned out to be much riskier than anticipated, it created a domino effect, with losses cascading through the financial system. The banking industry also played a significant role in creating and investing in complex financial instruments, such as mortgage-backed securities and collateralized debt obligations, which were designed to spread risk across the financial system. However, these instruments were often extremely opaque, which made it difficult to assess the true risk involved. When the underlying assets, such as subprime mortgages, began to default, these complex instruments rapidly lost value, contributing to the overall financial panic. Finally, the banking industry was also impacted by the collapse of the housing market and the broader financial panic. As the value of many of their assets rapidly declined, many banks suddenly found themselves with significant losses, which threatened their solvency and created a broader loss of confidence in the financial system. In the wake of the 2008 financial crisis, the banking industry has been subject to increased regulation and scrutiny. Policymakers have implemented a range of reforms aimed at improving transparency and reducing risk, including increased capital requirements, stricter lending standards, and greater oversight of financial markets. However, the legacy of the 2008 financial crisis continues to be felt, and policymakers and regulators must remain vigilant in their efforts to prevent a similar crisis from occurring in the future.
Subprime mortgages, how they led to the 2008 financial crisis. Subprime mortgages were one of the primary factors that led to the 2008 financial crisis. These were mortgages that were made to borrowers with poor credit histories, unstable financial situations, or other high-risk factors that made them more likely to default on their loans. The proliferation of subprime mortgages contributed to the housing market bubble and created a feedback loop that ultimately led to the collapse of the housing market and triggered the broader financial crisis. Lenders, including banks and other financial institutions, aggressively marketed subprime mortgages, often with adjustable interest rates that rose over time, making them increasingly unaffordable for borrowers. The subprime market grew rapidly, as many borrowers were attracted by the low initial interest rates and the promise of homeownership. However, many of these borrowers were unable to keep up with their mortgage payments as interest rates rose or their financial situation deteriorated. As defaults on subprime mortgages began to rise, it created a ripple effect throughout the financial system. Mortgage-backed securities, which were created by pooling together large numbers of mortgages and selling them as investment products, suddenly became much riskier as the underlying mortgages began to default. Many financial institutions had invested heavily in these securities, which were often rated as safe and reliable investments. When they began to lose value, it created significant losses for many financial institutions, which contributed to the broader financial panic. Subprime mortgages were not the only factor that led to the 2008 financial crisis, but they played a critical role in creating the housing market bubble and ultimately triggering the broader financial panic. In the aftermath of the crisis, policymakers have implemented a range of reforms aimed at improving lending standards and reducing the risk associated with subprime mortgages. However, the legacy of the crisis continues to be felt, and policymakers must remain vigilant to prevent a similar crisis from occurring in the future.
The role of derivatives, how they amplified the 2008 financial crisis. Derivatives were another critical factor that contributed to the 2008 financial crisis. These complex financial instruments were designed to spread risk across the financial system, but in practice, they amplified the impact of the crisis and made it much more difficult to untangle. Derivatives, such as credit default swaps, were created as a way for financial institutions to hedge their risk exposure. For example, a bank that had made a large number of loans could use a credit default swap to transfer some of the risk associated with those loans to another party. However, these instruments quickly became much more complex and difficult to understand, with many different layers of risk and uncertainty. As the housing market bubble began to burst, the impact of the crisis was amplified by the widespread use of derivatives. Many financial institutions had invested heavily in mortgage-backed securities and other complex financial instruments, which were often linked to derivatives. When the underlying assets, such as subprime mortgages, began to default, it triggered a cascade of losses throughout the financial system. The complexity of many of these financial instruments made it much more difficult for regulators and policymakers to respond effectively to the crisis. The interconnected nature of the financial system meant that losses in one area could quickly spread throughout the system, creating a broader loss of confidence and panic selling in financial markets. The impact of derivatives on the 2008 financial crisis was significant, and policymakers have implemented a range of reforms aimed at increasing transparency and reducing the risk associated with these complex financial instruments. However, the legacy of the crisis continues to be felt, and policymakers and regulators must remain vigilant in their efforts to prevent a similar crisis from occurring in the future.
The collapse of Lehman Brothers, how it impacted the 2008 financial crisis. The collapse of Lehman Brothers was one of the critical events that contributed to the 2008 financial crisis. Lehman Brothers was a major investment bank, and its failure sent shockwaves throughout the financial system and helped to trigger the broader financial panic. Lehman Brothers had been heavily invested in the housing market and in complex financial instruments such as mortgage-backed securities and collateralized debt obligations. As the housing market began to collapse and defaults on subprime mortgages began to rise, the value of these investments plummeted, and Lehman Brothers found itself with significant losses. Despite efforts to find a buyer or secure a government bailout, Lehman Brothers was unable to find a solution to its mounting financial problems. On September 15, 2008, the firm filed for bankruptcy, which sent shockwaves throughout the financial system. The collapse of Lehman Brothers had a significant impact on the 2008 financial crisis, as it created a broader loss of confidence in the financial system and triggered a wave of panic selling in financial markets. The failure of such a large and prominent financial institution highlighted the fragility of the financial system and the potential for a broader financial collapse. In the aftermath of the Lehman Brothers collapse, policymakers and regulators took a range of steps aimed at stabilizing the financial system and preventing a broader financial collapse. These steps included increased government oversight of financial institutions, stricter lending standards, and greater transparency in financial markets. The collapse of Lehman Brothers was a critical event in the 2008 financial crisis, and its impact is still felt today. The legacy of the crisis has led to increased scrutiny of the financial system and a greater awareness of the potential for financial instability. Policymakers and regulators must remain vigilant in their efforts to prevent a similar crisis from occurring in the future.
The Bailout Plan, how it tried to stabilize the 2008 financial crisis. The Bailout Plan was a key response to the 2008 financial crisis, aimed at stabilizing the financial system and preventing a broader economic collapse. The plan included a range of measures aimed at providing liquidity to financial institutions, stabilizing the housing market, and increasing government oversight of financial institutions. The centerpiece of the Bailout Plan was the Troubled Asset Relief Program, TARP, which authorized the U.S. government to purchase troubled assets from financial institutions in order to inject liquidity into the financial system. The government also provided funding to banks and other financial institutions to help stabilize their balance sheets and prevent a wave of bank failures. The Bailout Plan also included measures to support the housing market, including programs to help homeowners avoid foreclosure and to stabilize home prices. These measures were aimed at reducing the number of foreclosures and helping to stabilize the housing market, which had been a major factor in the financial crisis. In addition to these measures, the Bailout Plan included increased government oversight of financial institutions aimed at reducing the risk of another financial crisis. Regulators were given more power to monitor and regulate financial institutions, and new regulations were put in place to increase transparency and reduce the risk associated with complex financial instruments. While the bailout plan was controversial and faced criticism from both sides of the political aisle, it was ultimately successful in stabilizing the financial system and preventing a broader economic collapse. The plan helped to prevent a wave of bank failures and provided critical liquidity to financial institutions during a period of unprecedented financial instability. In the years since the financial crisis, policymakers and regulators have continued to implement reforms aimed at increasing the stability of the financial system and reducing the risk of another financial crisis. These efforts have included increased capital requirements for banks, stricter lending standards, and greater oversight of financial markets.
The stock market crash, how it affected the 2008 financial crisis. The stock market crash was one of the most visible and immediate effects of the 2008 financial crisis. The stock market experienced significant declines throughout 2008, with major indexes such as the Dow Jones Industrial Average and the S&P 500 falling to their lowest levels in years. The stock market crash was fueled by a range of factors, including the collapse of the housing market, the failure of major financial institutions, and a broader loss of confidence in the financial system. Investors fled from the stock market in droves, leading to significant declines in stock prices and a wave of panic selling. The impact of the stock market crash was felt throughout the economy, as businesses and consumers faced declining asset values and increased uncertainty about the future. The crash also had a significant impact on retirement savings and other long-term investments, as many investors saw their portfolios decline in value. The stock market crash was not the sole cause of the 2008 financial crisis, but it was a critical factor that contributed to the broader economic downturn. The crash highlighted the interconnected nature of the financial system and the potential for losses in one area to spread throughout the economy. In the aftermath of the stock market crash, policymakers and regulators took a range of steps aimed at stabilizing the financial system and preventing a broader economic collapse. These steps included increased government oversight of financial institutions, stricter lending standards, and greater transparency in financial markets. The legacy of the stock market crash continues to be felt today, as policymakers and regulators work to prevent a similar crisis from occurring in the future. While the stock market has largely recovered from the 2008 financial crisis, the impact of the crash serves as a reminder of the potential for financial instability and the importance of vigilant oversight and regulation of the financial system.
The global impact, how the 2008 financial crisis spread across the world. The 2008 financial crisis had a significant global impact, spreading rapidly across the world and affecting economies in nearly every region. The crisis had its roots in the housing market collapse in the United States, but its impact quickly spread beyond U.S. borders. The global impact of the crisis was fueled by the interconnected nature of the global financial system, with many countries heavily invested in U.S. financial markets and institutions. As the crisis in the U.S. deepened, it created a ripple effect throughout the global financial system, leading to widespread panic selling, declining asset values, and economic downturns in many countries. The impact of the crisis was particularly severe in Europe, where many countries had invested heavily in U.S. financial institutions and had significant exposure to the housing market bubble. Several European countries, including Greece, Spain, and Ireland, experienced severe economic downturns and faced significant challenges in stabilizing their financial systems. The crisis also had significant impacts on emerging markets, particularly in Asia and Latin America. Many emerging market economies had relied heavily on exports to developed countries, and the downturn in developed economies led to declining demand for their goods and services. This, in turn, led to declining economic growth and rising unemployment in many emerging market economies. The global impact of the 2008 financial crisis highlighted the interconnected nature of the global financial system and the potential for financial instability to spread rapidly across the world. It also highlighted the need for coordinated global responses to financial crises and the importance of increasing the resilience of the global financial system. In the years since the crisis, policymakers and regulators have taken a range of steps aimed at increasing the stability of the global financial system and reducing the risk of another financial crisis. These efforts have included increased international cooperation and coordination, stricter regulation of financial institutions, and greater oversight of financial markets.
The recovery process, how the economy responded to the 2008 financial crisis. The recovery process from the 2008 financial crisis was a long and challenging journey for the global economy. The crisis had caused significant damage to the financial system and had triggered a broad economic downturn, with high levels of unemployment, declining asset values, and a lack of confidence among consumers and businesses. The recovery process began with a range of measures aimed at stabilizing the financial system and preventing a broader economic collapse. These measures included government bailouts of financial institutions, monetary policy interventions, and fiscal stimulus programs designed to boost economic growth. Over time, these measures helped to stabilize the financial system and prevent a broader economic collapse. The global economy began to recover, with increasing levels of economic growth, declining unemployment rates, and rising asset values. However, the recovery process was slow and uneven, with some countries and regions experiencing a more robust recovery than others. Many developed countries faced long-term challenges, including high levels of public debt, sluggish economic growth, and rising income inequality. The recovery process was also complicated by a range of external factors, including the Eurozone debt crisis, geopolitical tensions, and the ongoing impacts of globalization and technological change. Despite these challenges, the global economy has made significant progress in recovering from the 2008 financial crisis. Unemployment rates have declined, asset values have risen, and economic growth has resumed in many countries. In the years since the crisis, policymakers and regulators have continued to implement reforms aimed at increasing the stability of the financial system and reducing the risk of another financial crisis. These efforts have included increased capital requirements for banks, stricter lending standards, and greater oversight of financial markets.
Regulatory reforms, how governments tried to prevent another financial crisis. The 2008 financial crisis highlighted the need for regulatory reforms aimed at preventing another financial crisis. In the aftermath of the crisis, governments around the world took a range of measures aimed at increasing the stability of the financial system and reducing the risk of future crises. One of the key areas of regulatory reform was increased oversight and regulation of financial institutions. Governments around the world implemented stricter capital requirements, designed to ensure that banks had enough reserves to absorb potential losses. They also implemented stress tests, designed to assess the resilience of financial institutions under different economic scenarios. In addition to these measures, regulators also focused on improving transparency in financial markets, including through increased disclosure requirements for financial institutions and the introduction of new reporting standards. Another area of regulatory reform was the increased oversight of financial products and markets. Governments introduced new regulations aimed at reducing the risk associated with complex financial instruments, such as derivatives and structured products. They also implemented measures to improve the oversight of credit rating agencies, which had been criticized for their role in the crisis. Governments also focused on improving consumer protection in financial markets, implementing measures aimed at preventing predatory lending and improving the transparency of financial products. Finally, governments focused on improving coordination and cooperation between regulators and central banks, both domestically and internationally. This included the establishment of new bodies, such as the Financial Stability Oversight Council in the United States and the European Systemic Risk Board in Europe, designed to improve coordination and cooperation between regulators.
Lessons learned: what we can learn from the 2008 financial crisis. The 2008 financial crisis was a significant event that had a lasting impact on the global economy. While the crisis was a challenging and difficult experience for many, it also provided important lessons that can help us prevent future financial crises. One key lesson is the importance of risk management and regulation. The crisis highlighted the potential for complex financial instruments to create systemic risks and the need for greater oversight and regulation of financial markets. Moving forward, policymakers and regulators will need to remain vigilant and continue to implement measures aimed at reducing the risk of financial instability. Another lesson is the importance of transparency and accountability in the financial system. The crisis highlighted the need for greater transparency in financial markets, particularly with regard to complex financial instruments. It also underscored the importance of holding financial institutions accountable for their actions, including through increased penalties for wrongdoing. The crisis also highlighted the importance of economic resilience and diversification. Many countries and businesses suffered significant losses during the crisis due to their over-reliance on specific sectors or industries. Moving forward, it will be important to focus on diversifying economies and building resilience to economic shocks. Finally, the crisis underscored the importance of international cooperation and coordination in addressing global financial challenges. The crisis spread rapidly across borders and affected economies around the world, highlighting the need for a coordinated global response to financial instability.
Public perception: how the 2008 financial crisis changed public perception of the banking industry. The 2008 financial crisis had a significant impact on public perception of the banking industry. The crisis revealed numerous instances of fraud, deception, and unethical behavior among some financial institutions and their executives. This, in turn, led to widespread public mistrust of the banking industry and a heightened awareness of the potential risks associated with complex financial products. The crisis also had significant impacts on consumer behavior, with many individuals becoming more cautious about their investments and savings. Many consumers began to question the safety and soundness of the banking system, and many shifted their assets away from traditional banks and into safer investments, such as government bonds and savings accounts. The crisis also led to increased scrutiny of financial institutions and their executives. Governments around the world implemented stricter regulations and oversight of the banking industry, and many executives were held accountable for their actions during the crisis. The public perception of the banking industry has continued to evolve in the years since the crisis. While many consumers remain wary of the industry, there has also been a growing recognition of the important role that banks play in the economy. Banks provide critical services such as lending and investment, and they play a vital role in supporting economic growth and development. Despite these positive developments, the banking industry continues to face challenges in rebuilding public trust. The continued prevalence of unethical behavior and financial misconduct among some financial institutions has undermined public confidence in the industry, and many consumers remain skeptical of the safety and soundness of the banking system.
The cost of the 2008 financial crisis: assessing the economic impact. The 2008 financial crisis had a significant economic impact, both in the short and long term. The crisis led to a sharp decline in economic activity, with many countries experiencing a severe recession. The crisis also led to significant job losses and declines in asset values, causing widespread economic hardship. In the immediate aftermath of the crisis, governments around the world implemented measures aimed at stabilizing the financial system and preventing a broader economic collapse. These measures included government bailouts of financial institutions, monetary policy interventions, and fiscal stimulus programs designed to boost economic growth. Over time, these measures helped to stabilize the financial system and prevent a broader economic collapse. The global economy began to recover, with increasing levels of economic growth, declining unemployment rates, and rising asset values. However, the recovery process was slow and uneven, with some countries and regions experiencing a more robust recovery than others. Many developed countries faced long-term challenges, including high levels of public debt, sluggish economic growth, and rising income inequality. The cost of the crisis also extended beyond the immediate economic impact. The crisis highlighted the potential risks associated with complex financial instruments, leading to increased regulation and oversight of financial markets. It also had a significant impact on public perception of the banking industry, leading to increased scrutiny and regulation, as well as a greater awareness of the potential risks associated with complex financial products. In addition to these impacts, the crisis also had significant costs in terms of lost economic output and productivity. Many businesses were forced to close or downsize during the crisis, leading to lost output and lower levels of economic growth. The crisis also had a long-term impact on productivity, as many workers and businesses struggled to recover from the downturn.
The legacy of the 2008 financial crisis, its continuing impact on the economy today. The 2008 financial crisis had a lasting impact on the global economy, and its legacy continues to be felt in several ways today. One key area of impact has been on the financial industry itself. The crisis led to significant regulatory reforms and increased oversight of financial institutions as governments sought to prevent a repeat of the crisis. This has had a profound impact on the way that financial institutions operate today, with many banks and other financial firms focusing on risk management and compliance in order to meet regulatory requirements. The crisis also had a significant impact on consumer behavior, particularly in terms of borrowing and saving. Many consumers became more cautious about taking on debt, and there was a shift away from risky investments towards safer, more conservative options. This has had implications for the overall level of economic activity, as consumers have been more hesitant to take on debt and spend money. Another area of impact has been on the broader economy. The crisis led to a significant decline in economic activity, and many countries experienced a severe recession. While the global economy has since recovered, many developed countries have struggled with slow growth and persistent unemployment, particularly among younger workers. The crisis also had a profound impact on public perception of the banking industry and the role of government in the economy. Many people became more skeptical of the financial industry and more critical of government policies that were seen as favoring the interests of the wealthy over those of ordinary people. Overall, the legacy of the 2008 financial crisis is complex and multifaceted. While the global economy has recovered in many ways since the crisis, it continues to face challenges related to slow growth, persistent unemployment, and rising inequality. At the same time, the crisis has spurred significant reforms in the financial industry and increased awareness of the importance of risk management and regulatory oversight. As we continue to grapple with the ongoing impacts of the crisis, it will be important to remain vigilant and focused on building a more stable, resilient, and equitable global economy.